Great. Well, it's a pleasure to be here this evening to talk about long-term investment in the context of high-yield bonds. Now, I think Russ's presentation contained lots of great advice. Not very many people invest directly themselves in high-yield bonds for the simple reason that you have to have quite a lot of money invested in any one bond for that to be a practical solution. So many of you may be more familiar with bonds through funds, such as the one we're going to be talking about this evening. And you perhaps won't be surprised to hear echoes of Russ's advice in the principles that we use in investing in the high-yield bond market. Anybody who knows Baillie Gifford will know that we are passionate about long-term investing. For those of you who don't recognise the name, our firm was established in Edinburgh more than 100 years ago as an unlimited liability partnership. And those two core features still hold true today. We are based in Edinburgh. We have over 100 investors, all based in Edinburgh, and we remain an unlimited liability partnership. So 43 partners, all working in the business, no outside ownership. Fund management is the only thing that we do. So we only succeed in the long term if we deliver great results for our clients over the long term. Curiosity about what is happening in the world and what the future holds is what our investors have in common. And if I show you the high-yield team at Baillie Gifford, this group of people embody that curiosity and passion. And together we are responsible for managing the high-yield bond fund. Just to give a little bit of context to my remarks this evening, a few key points about the fund in question. So our fund has been running since 2001, which was pretty much the birth of the European high-yield bond market. High-yield bonds are higher risk loans to companies that you can trade between investors. It's an idea, a concept that came over from the US. Interesting beginnings to that market in the late 80s, but it's pretty new in 2001 when we started our fund. And our approach has been consistent since then. We have been selectively investing in a relatively concentrated portfolio of 50 to 90 companies that we think will deliver across the cycle. That consistent approach has delivered excellent results for clients over the long term, and you can probably not see those numbers in detail, but if you interrogate the slides on request, you will see them there. But we're particularly pleased that the long-term numbers are very good. So over 10 years, we're kind of top of the pops within that sector or close to it. So that's enough blowing our own trumpet. I think because many people don't invest directly in the high-yield bond market, there are a few core features of the market that bear explaining so that when you're evaluating different fund options, you can understand the key questions to ask about the strategies that people employ to invest in high-yield bonds. So all investors in the high-yield market face a number of challenges which can impact on returns. The first of these is volatility. Now, relative to equities, this doesn't seem like a big deal, but relative to other bond investments, high-yield bonds are very much at the higher risk end of the spectrum. Prices are driven by credit conditions, by animal spirits, and they go up and down in a way not dissimilar to equities. What that means is that the cost of a bad decision in the high-yield bond market can be high. The second point actually ties in to the Warren Buffett observation around don't lose money. Unfortunately, you can lose money in high-yield bonds. The attraction of fixed income is you get your regular interest payment, your coupon payment, and you should get your money back at the end. High-yield bonds pay you a higher rate of return, but it does come with higher risk. On average, over the 15 years or so that the European market's been around, about 3% of companies in this market have failed to repay their investors in any given year, although, as the chart shows, that is not even. So there are clusters of defaults which coincide actually relatively closely to the down periods in equity markets as well. So minimizing losses to default, trying not to lose money is a key part of the value added in the high yield market. Our default rate has been a little under 2% compared to that 3% figure for the market as a whole. Something that may not be obvious is the extent to which the high yield market is a moving target. So the composition of our market changes relatively rapidly from year to year. I apologise for the challenge in reading any of these figures. The broad message here would be that about 15 to 20% of the market in any year is comprised of new issuers, companies that weren't borrowers in the market last year. They bring new bonds to market. And conversely, a fairly similar proportion of companies exit the market. They repay their bonds, or a small fraction of them default, but they repay their bonds and maybe they borrow from a bank instead, or maybe they're acquired by a bigger company, or in some cases they may raise equity to repay their debts. So to avoid owning the same portfolio as everybody else and being very distracted by the new issuance process, because there's a lot of activity in the market, it's really important to be very clear as an investor about what you're looking for in the market to narrow down that opportunity set, and to be prepared to hold a portfolio that's different to your peers. And finally, as an echo here again of the importance of costs. High yield bonds are a relatively higher cost market to trade in, so it would not be uncommon if I was to buy and sell a given bond, even as an institutional wholesale investor dealing in millions of pounds worth of a single bond. If I were to buy at the start of the day, sell at the end of the day with no change in market conditions, would easily be 0.5% to 1% poorer than I was at the start of the day. It's an expensive market to trade in relative to government bonds or even equities. So the observation there is that actually being a long-term investor is very much to your advantage, minimizing that headwind to returns from turnover. That's lots of doom and gloom about the challenges of investing in high yield. I'd like to explain how we invest for the long term in high yield bonds and how we've successfully navigated those challenges. We strongly believe that the most important feature of a successful high yield investment isn't growth, and it's not even the starting yield. It's the resilience of the company that you're investing in, the quality of the business that you're investing in. Can this company meet the obligation that it has undertaken? If it's promised to pay you 5% for the next 7 years, is there a good prospect that in a wide range of circumstances they can afford the debt that they've taken on? And that is by no means universally true of the companies that we could invest in. So seeking out resilience is at the heart of our investment process. Our process is focused entirely on making one set of decisions really well, and that's identifying great companies with bonds trading at an attractive valuation. We start from the bottom up. We know our portfolio very well, and we spend time thinking about the risks that can accumulate in any portfolio that you put together of 50 or 90 stocks. So we have to think about the top down from that point of view, but we are coming at it from the bottom up, and we're not starting as thematic investors, worried about the latest pronouncement from central banks or which way monetary policy is moving and the economy is moving. There's a huge, wide-ranging set of factors there that are very heavily picked over, very difficult to profit from, and actually don't have a lot of bearing, as Russ mentioned, on the fundamental performance of most companies most of the time. We do focus very heavily on what we own, and that is both in terms of very closely monitoring the performance of the companies that we're investing in, as well as that risk analysis across the portfolio. And we do invest patiently. We have a 3-year investment horizon for our portfolio, which in the context of equity funds, you might say is not incredibly long-term. But in the context of bonds that typically are redeemed after not much more than 3 years, and in some cases in less than 3 years, in the context of this particular market, that is a long-term investment. And our turnover figures bear out that aspirational time horizon. So between 20 and 30% of our portfolio will turn over, will buy new investments and sell a corresponding amount of the existing portfolio in any given year. That lower turnover has a very beneficial impact on the costs that the portfolio has to meet and then beat to generate a great return for clients. So in practice, the first step in this process, I've described the kind of the philosophical underpinnings of our approach, but the first step is generating great ideas with which to populate the portfolio. And my key observation here is that we start with a big investable universe, and we have a lot of different ideas coming to us. And the most important observation here is that we start with fundamentals first. We do not start with valuation. We try not to get suckered in by a high yield. The sustainability and resilience of the businesses that we invest in is absolutely crucial. And it's only once we have a decent first pass on that fundamental resilience that we will consider the question of valuation. And valuation is really important. And we've already seen, you can buy a great company, but if you buy it at the wrong price, you're not going to make a lot of money. The same is true to an extent in the high yield market. You can lend to some great businesses, but if everybody knows they're a great business, they're going to pay you very little, and that's not going to be a profitable strategy either. But we think it's crucially important to start with the fundamentals and only then to address the question of valuation. So once we've generated an idea, we then start our deep dive fundamental analysis. So this is a fairly resource-intensive process that I'm describing here. We have 7 people working on this portfolio, so we have around 10 companies on average per person that we're responsible for covering on an ongoing basis, and each of us may have to come up with 2 or 3 new ideas over the course of the year as low turnover investors with 20 to 30% turnover. So we do go into a great deal of depth in analysing the risks we might be taking if we invest in a company. So this example uses a company that would be familiar to many of you, Jaguar Land Rover. So it's coming in, having passed that first test of basic resilience. Clearly, it is a company where people are prepared to pay for their products. It is a company that had longevity. It's a company that's now owned by the Indian conglomerate Tata, and so it has substantial financial backing behind it. So lots of good points to start off with. And we found bonds that we thought had a reasonable valuation opportunity. That then is the starting point for the deep dive analysis. We try and do the first step quickly, analysing lots and lots of companies quickly. But once we think we've found something really interesting, that's when we slow down and walk through the steps here. So we are deliberately and explicitly being pessimistic. We're saying, what can go wrong with this investment? There's lots to like about the company. That's why I'm looking at it in the first place. But let me be clear about where this can go wrong. So I'm stress testing particular downsides. In this case, the phenomenal success of Jaguar Land Rover's business in China is something that could, and to an extent recently has, gone into reverse. So they've sold enormous volumes, and they've sold them at very high prices as well, exported from the UK into China. And so when we made this investment, we were thinking, to what extent can that go wrong? Can that go into reverse? And if it does, how serious is the impact on us as investors? Does that imperil their ability to pay their debts? Secondly, as a relatively small manufacturer in the global scheme of things, albeit very successful, they're still relatively small, and they're making big, high-performance vehicles not known for their fuel economy. We live in a world of increasing regulation and ever more demanding environmental performance standards. How does this company invest to meet those standards? We take those 2 concerns and we make them specific and map out over the next 3 years, how could that play out? and how serious is the downside risk for us as investors. Clearly, this is a name that got into the portfolio. We were happy with the quantum of the risk that we're taking. This is a company that starts, unusually for high-yield companies, with more cash on its balance sheet than it does debt. That's pretty unusual. Most higher risk businesses, you would expect to have a lot more debt on the balance sheet than cash. Jaguar Land Rover is in great shape. So then we're thinking, okay, I think this is a great business. I've thought hard about the downside. This is a bond, and that means I have a contractual relationship. I'm not in a position of fractional ownership. I don't have unlimited upside when I lend to Jaguar Land Rover. The best case is I get paid a reasonable income and have a very low risk of not getting that money back. So I need to examine that contractual relationship and make sure I really understand it and what options the company has and how they could be exercised in ways that are unfavorable to investors. In this particular case, actually, there are a couple of positive features that come out of that analysis. So the particular terms of this bond say, as long as the company is relatively lowly credit rated, so it falls into the high yield market, its credit ratings from Moody's and Standard & Poor's are relatively low. There's a fairly onerous restriction on how many dividends they can pay to their owners, so they have an incentive to improve their credit quality, and that helps us as investors. They're seeking to de-risk their business, which is good for us. And they also can't redeem these bonds early. Now, you may say that's a double-edged sword. Actually, when you're lending to an improving business, the last thing you want is for them to take the bonds away from you early. You want to earn that income, experience the falling risk, generally see a revaluation of the bonds, and here we are able to capture that upside without the threat of those bonds being redeemed early, which is actually quite common in the market. We take a closer look at valuation, and interestingly, we didn't buy first time that we looked at this. We liked the company, it passed the stress tests, we were happy with the terms, but it didn't meet our valuation criteria when we first looked at it. Happily, a better opportunity did emerge a few months later, so we declined in August 2015, but we bought the bonds later in February of 2016. And to take us into the next stage, into tracking this investment and thinking about how it fits with the rest of the portfolio, a really important part of our process is identifying milestones. What am I hoping to see? What evidence will support the positive investment case that I've set out? And what will highlight to me where I've gone wrong? Because clearly we don't get everything right, but recognizing your mistakes and acting appropriately is a really important part of that process. So being explicit at the outset of our investment about what those milestones are is hugely important. So I'll just quickly continue the Jaguar Land Rover example and maybe pick up another one to talk about how this process works for us in practice. So Jaguar Land Rover gets into the portfolio. I've got two axes here on the horizontal axis, price movement. So the two examples on the right, those bonds have performed well in price terms. On the left, those bonds have underperformed, they've performed poorly. The name's on the top, because we're monitoring valuation and we're monitoring fundamentals. And the fundamentals are tracking positively at the top and negatively at the bottom. And the point is monitoring these different situations. Each company over time will perform well or badly. Its bonds will move up and down, not entirely related to fundamentals. The different circumstances will drive different portfolio actions. So here you can see in the case of Jaguar Land Rover, actually, more recently, their profits have started to come under pressure because of strong competition in the SUV segment, where they've had a great product. It's done phenomenally well, but it has attracted a lot of competition. And we're also slightly concerned that the availability of consumer finance is becoming a little bit tighter, having been extraordinarily loose. Everybody's buying cars on credit, but that's become suddenly very topical and maybe going slightly into reverse, which affects the margins ultimately that the car makers achieve. But the bond price has remained elevated, so our action there is to reduce the holding. Conversely, Iceland Foods is an example of the opposite situation where our conviction in the business, albeit it's a bit down market and it may not be the place that we all choose to shop, but they know their market extremely well. They've coped with competition from the discounters extremely well. When their bonds performed actually very badly, our fundamental conviction in the story helped us to hold on. And that has subsequently worked out very well, as they have held their own even while the likes of Tesco and Asda have been suffering. There's doubtless not a lot that you can recognise on there. My only point here is to say, when I look at this, there's a mix of familiar and unfamiliar names in the portfolio. This is everything that we own. I see a lot of opportunity, and I'm looking at the relationship between those holdings. From your point of view, what I would emphasise is diversification and the balance of the portfolio. So hopefully what you've taken away from that is a small insight into how we think about investing for the long term in the context of high yield bonds.